Welcome to the Cinnaire MSHDA 2020 Virtual Asset Management Conference. Thank you for your interest in our virtual sessions. We hope you enjoy C is for Compliance.
Welcome everyone to the compliance session of the MSHDA Cinnaire 2020 virtual conference. My name is Holly Sweis. I am the Vice President of Intrepid Professional Group, and we are excited to be a part of this awesome event. We can all agree that 2020 has definitely had its changes and challenges, and so this compliance session hopefully will broaden your knowledge on the effects that 2020 has actually had on our industry. So I'm excited to introduce Nancy Morton from Davie O'Connor and Zielinski and Cassandra Brown from MSHDA. Hi guys, thank you so much for being here today and your willingness to present. Nancy is here to share her expertise within all the compliance changes. She's going to explore in detail the state of the industry with updates on general topics such as the CARES Act and its implications, the Paycheck Protection Program, and then the status of the Affordable Housing Credit Improvement Act. Nancy's also going to touch on some of the rules and actions that are affecting partnerships out there and other development related activities. And then to conclude the compliance session, Cassandra Brown is going to speak on the new utility allowance changes that are at MSHDA, as well as the exciting new rollout of the e-signature policy. So virtual audience, please feel free to raise your hand and ask questions. And we're really excited to get this along the way. So without further ado, here's Nancy.
Thank you, Holly, so much. And thank you so much for allowing me to be a part of this conference this year. So there are 6 topics that I'm going to be talking about today to kind of give you an overview of what the state of the light tech industry is like right now. As Holly said, 2020 has definitely been a unique year and hopefully a year that we'll never see again. So the first thing I'd like to talk about is the Form 8609 and the reasonable cause approach to the first year credit. But before I begin, I just want to take a brief moment to talk about a little background information. Internal Revenue Code 42L1 requires that taxpayers complete a certification with respect to the first year of the credit period. What does that mean? Typically, that means 2 different things. To do the certification, you have to complete Part 2 of the Form 8609 once it's been provided by the state agency. This form is completed under the state agency, and it's both for allocated credits or the 9% credits and also credits financed with tax-exempt bonds. Once you receive this Form 8609, then you complete this and you submit this to the IRS. On a yearly basis, the Form 8609A must be completed each year for the taxpayer to claim the credit, including the first year of the credit, and that is attached to your tax return. During a federal tax audit, the IRS will determine if the operations of the project is consistent with the information and elections that are documented on the Form 8609. That's been the way it's been since 1986 when the tax credit first came into existence. Unfortunately, there's a current year issue. Under the new BBA centralized audit regime, a partnership can no longer file an amended 1065 or issue amended Schedule K1s to the partner. So what does this mean? Historically, you would get a draft of a return that would have credits. A lot of times the fund would go ahead and take credits in the year that they were anticipating. The lower tier partnership would take the credits off of the tax return. They would file an amended return. If the fund would ever get audited, by the time the fund would get audited, you would have an amended K1 that showed the credits. Everything worked out great. Unfortunately, that is no longer the case. Under the new BBA procedures, what happens is that you no longer file an amended return. You file a AAR under Form 8082. And what this does is that if you were supposed to take credits in 2018, you do not get your 8609s until 2020. So you follow that AAR in 2020. that is the year that you take those first year, you true up and take all of those credits, which obviously causes a tremendous impact on your rate of return and what the funds were anticipating seeing. So in theory, the funds wouldn't get to take credits in 2018 or 2019, and they would true up those credits in 2020. Not a very good situation. So what has happened is through the entire industry, they've gone back and looked at the Section 42 to find out if there was another method in which we could go ahead and claim those credits in the year that you were anticipating them. And there is. It's called the reasonable cause approach. Section 42 I1E states, in the case of a failure to make a certification requirement, you cannot take credits unless it's shown that the failure is due to reasonable cause and not willful neglect. So what does that mean? That means that if you've gone ahead and submitted your final cause certification and you're just waiting for the state agency to submit the 8609s, it appears likely, based on what the industry is thinking right now, that you can go ahead and show the returns on both the lower tier and the fund return, as long as you file certain procedures. This code section places the burden on the taxpayer to show a reasonable cause for claiming any credits without the required 8609s. So how would you do this from a practical standpoint? In order to take the credits, the industry has come up with the following procedures. You're going to have a statement attached to the tax return detailing out the reasonable cause, including to, but not limited to, the time frame it takes the state agency to process the 8609s, when the cost certification was submitted, and how the taxpayers followed up on that certification. You're also going to schedule out and submit a schedule showing how the first year credits are calculated, which would be very similar to if you could have completed the Form 8609As, which you cannot complete as long as you do not have an 8609. You're going to go ahead and complete the 8586. And since, as I stated before, the 8609 is not completed, these returns will need to be paper filed. Because one of the questions on the 8609 specifically says, do you have the form from the state agency? So based on this, the industry feels comfortable that for most of the situation that we can go ahead and take those credits in the year that we anticipated, and that from all the guidance we've received from the IRS, this appears to look like this is going to be a reasonable solution up until the time that either the IRS changes the questions on the form or there's some additional guidance. The next thing to look at is IRS Notice 2053, which is granting deadline relief for LIHTC properties in the wake of COVID-19. So the IRS issued this notice to provide tax relief to issuers, operators, owners, and tenants of qualified low-income housing projects that were financed with and without tax-exempt bonds and state agencies that have jurisdictions on these projects. So what are some of the big ticket items that this notice gave us? For certain time-sensitive actions, they've gone ahead and said that if there were situations where you were going to have to perform something between April 1st and December 31st, the owners and operators now have until December 31st, 2020 to perform these actions and satisfy the requirements. This includes the 10% task for carryover, the 24-month minimum rehab period, the reasonable cause for restoration and replacement in the event of a casualty loss, the reasonable restoration period for a prior major disaster, and the 12-month transition period to meet the set aside for qualified residential rental projects. And the whole reason is this is because of COVID, so many things were shut down for such a period of time that this is allowing you extra time and not having you adversely affected because of COVID-19. In addition, between April 1st and December 31st, owners of qualified low-income housing projects are not required to perform certain income recertifications at that time period or reduce the eligible basis in a building because of the temporary closure of amenities or common areas due to the COVID-19 pandemic. which makes sense. And that was one of the things people were really worried about, is all of a sudden you said people could no longer go into the community rooms, or they could no longer use the swimming pools or the playground. All of a sudden, does that mean that we now have a recapture event? Which, looking at the direct writing of the law, could potentially mean yes, but this notice has given us relief saying that is not the case. In addition, from the state agency's perspective, they're not required during April 1st through December 31st time period to conduct compliance monitoring. This notice is very important, did not waive initial tenant income certification. So the initial tenant certification still has to happen. The notice also did not give guidance on whether or not the IRS waived annual student status verifications. The notice did not give guidance regarding an additional extension of time for non-compliance correction periods. Even though the notice 2053 waived the income recertification for mixed income property, the state agencies may still require income recertifications. That's up to a state by state to determine that. The owners of the projects are allowed to put in medical personnel and other essential workers during this time through December 31st, 2020, similar to what happened for displaced individuals as defined in Revenue Procedure 2014-49 and 2014-50. In addition, if bonds are used to provide qualified residential rental property, and if Section 147D, the 2-year rehab period, has been extended to December 31st, the last day of that period is also postponed to December 31st. So what is happening is that instead of having to worry about something happening in July, August, and September, everything is going to year end, which hopefully will make it a little bit easier for everyone to stay in compliance. Another area in which, and this has happened, is IRS Notice 2020-58, which is certain rehabilitation credit deadline. So under the historic tax credits, you have a 24-month period in which to accumulate your cost. Because of COVID-19, the IRS is postponed to March 31st, 2021, the last day of the 24 60-month period for taxpayers to pay or incur qualified rehabilitation expenditures. This results in situations where the taxpayer may have a measuring period that is longer than 24 60 months. And this is only during to this certain time period and only because of this notice. Let's talk a little bit about updates on average income set aside. Again, before we begin, let's go with the basic overview. The Consolidated Appropriation Act of 2018 added a third minimum set aside beyond the 20 at 50 and the 40 at 60 set aside. The average income set aside is when at least 40% of a project units have to be both rent restricted and occupied by individuals whose income do not exceed the imputed income limitation designated by the taxpayer with respect to the respective unit. The average of the imputed income limitation cannot exceed the 60% of AMI. So we always, before we had the 20 at 50 or the 40 at 60, now our designated imputed income limitations must be in 10% increment, going from 20% and ending at 80%. So that's what the basics of the average income. What is the current status of average income? Since 2018, when this came out, more states and syndicators are becoming a lot more comfortable with the average income. Unfortunately, the IRS has not yet provided final regulations on average income. Some individuals in the tax credit industry believe that average income will become the new de facto set aside in the future. Similar to the fact that in most situations, the de facto set aside historically has been 40-60. There's a lot of developers and people in the industry that believe that the new de facto set aside will be the average income because that gives you a lot more flexibility. There has been in January of 2020 a new revenue ruling that helped in one area, which is calculating the income limits for the LIHTC properties. Before this ruling, the income limits were calculated under Revenue Ruling 89-24, and HUD only had to give you the 50% income limits and the 60% income limits. Now, because of this ruling, HUD is now required to do going from 20 to 80% and giving what those income limits are going to be. Rent is also calculated based on those income limits. Since the release of the revenue ruling, HUD has updated the 2019 limits to incorporate the 20, 30, 40, 50, 60, 70, and 80 income limits, and will continue to do so. This list can be found at www.hudresourcescenter.com. So that's one of the ways that people were worried about is what are the true income limits? And we now have some additional guidance. When we'll get it, final regulations on the average income is yet to be determined. It sure didn't help with the COVID-19 pandemic on getting these final regulations. And with everything else going on, that is probably not one of their top priorities right now. So I think we may be waiting a little bit to get any additional information on average income. But most people are beginning to feel a lot more comfortable with it than they did in the past. One area that's similar to or like a complement to the LIHTC industry because of our developers and our general partners are the net operating loss changes. There's been a temporary repeal of the 80% of the taxable income TCJA limitation. Prior to tax reform, you could use your NOLs and offset 100% of your income. After tax reform, for new NOLs, you only could use it to go against 80%. So if you had general partners or developers who had huge losses, that they were somewhat limited. The Section 2303 of the CARES Act removed this limitation entirely for taxable years beginning before January 1, 2021. The 80% limitation remains in place for taxable years beginning after December 31st, 2020. So that gives us a little bit of relief. And again, I think it's a way to give more cash and ability back to the general partners so they can use those funds for other things. There's also been a modified rule for the NOLs. The new law says that you can only carry forward NOLs, not carry back like you could historically do. Because of the CARES Act, there's a modified rule. We restored a limited carryback pursuant to which NOLs arising in tax return years beginning after December 31st, 2017 and before January 1st, 2021. They may be carried back to each of the 5 preceding taxable years. An important thing to note, because I actually had a client ask me this question, is that I had a client that had a large income in year 3, and she was like, well, I get to pick and choose what year I'm carrying this NOL back to. And the answer to that is no. If you're carrying it back, you have to carry it all the way back to the 5th year and then carry it forward.
Okay. Nancy, we do have a question. So how are developers and owners, how have they reacted to the NOL rules? Has it been mainly positive or negative or indifferent?
They've been very positive, and that's one of the things that they're looking at is that, again, because of these NOLs, this is being able to get a lot more tax dollars back and a lot higher refunds than that they would have had under the Tax Reform Act. An interesting thing to note, though, is that, again, we had another client that had a situation where they had some NOLs that they possibly could carry back. But remember, the old NOLs, you could only carry them for 20 years and then they disappeared. So if they took these 2018 and 2019 NOLs and they carried them back, then that would mean that they could no longer use those earlier NOLs. So they had a bunch of NOLs in like 2006. So in some situation, it's one of those things that just because it sounds good, you need to do the analysis, because you might be better off allowing those old NOLs to be able to be used so that you don't ultimately use NOLs because they stop existing after 20 years.
Okay. Okay. You know what? We've got another question here. Mary, do you have that one? Oh, I actually do. Okay. Is there a final ruling on how to handle the next available unit rule for income averaging properties?
No, not yet. Again, that's one of the things that we're looking at for the final regulations and hope for the next available unit rule. And one of the areas in which there have been some states and some syndicators that is the whole reason that they've not liked mixed use properties that have both market rate and LIHTC units.
Definitely.
Any more questions at this stage?
Not that I see.
So then the final thing that I kind of want to talk about today is the tax consequences of the PPP loan. Again, let's start with going a little bit of background. So the applications for the PPP loans were accepted through August 8th, 2020. 60% of the loan funds must be spent on payroll, and the remaining 40% of the remaining categories of eligible costs, including mortgage interest, rent and leases, and utilities. There is a 24-month period in which to utilize the PPP funds from the initial 8 weeks. So it started at 8 weeks, and then they came back and they extended it to a 24-month period, a 24-week period. So what does that mean? That once you've utilized all your funds, and either during the initial 8 weeks or sometime within that 24-week period, then you have to go and you have to do the PPP forgiveness application. So there are two different ways that you can do this. The Form EZ can be used if the taxpayer did not reduce salaries and wages of their employees by more than 25% and did not reduce the number of hours of their employees. Then you can file the EZ form. If that was not the case, then the full form includes adjustment for reduction in compensation and employment levels. These are very important things to note. Any documentation submitted for the PPP forgiveness application must be retained for a minimum of 6 years. And another item to note, that if you are able to get this debt forgiveness because of this PPP loan, no deduction for the PPP expenditures where the loan is forgiven under can be deducted under IRC section 265 and notice 2020-32. So a lot of times what we thought was, they said this is tax exempt income, so this is free money. In the case of that, in some respects, you're not going to show a debt forgiveness, but if you have $100 of loan forgiveness and you use that $100 for wages, those wages are no longer deductible. So in essence, that forgiveness, that income you got, is going to have a tax consequence to it.
Okay. Nancy, we've got a question here. How big of a deal is the inability to deduct the P loan expenses, and what was Congress's intent on that? It's kind of a two-part. And then how does timing of the forgiveness impact the 2021 return?
That's a very good question, and that's yet to be seen on some of it. So it will depend on when you get that forgiveness. So what happens is so if you have $1,000, and let's say you're in the 30% tax bracket, so you get this $1,000 that you now can spend on $1,000 of salary and wages. So the $1,000 may not be taxable, but that $1,000 of expenses would have reduced your taxes by $300. So that's the cost. You get $1,000, it's going to cost you $300.
Okay.
Now, what we're looking at right now is, so if you have those that forgiveness, but they don't determine if that forgiveness happens until the following year, then there's some discussion, but we believe that you're going to go ahead and take the expenses in 2020. And then once that loan is forgiven in 2021, in essence, you will reduce the expenses the following year or pick up that income.
Right. Okay. Okay.
But those are great questions. And a lot of people, including the AACPA, really felt like that the ultimate intent was that this was free money and you still were going to be able to take the deductions. And that's what they're hoping that the IRS was going to come back with. But unfortunately, notice 2020-32 clearly stated that those deductions were not going to be deductible for tax purposes.
So Nancy, I heard that some small loans may have automatically been forgiven. Have you heard anything about that?
There are some of those, the very small loans that are going to be automatically forgiven. But again, take into consideration, if it's forgiven, those expenses are not deductible.
Right.
And I think that the whole reason for that is that if you're looking at a small enough dollar amount and you're just looking at the small businesses, what they're trying to do is make it easy as possible and to reduce the cost that the companies are going to have to go ahead and get these loans forgiven, and the work that either the banks or the government is going to have to do to forgive those loans.
Right. Okay. These are great questions, guys.
And that is, unless there's any other questions, that kind of gives you an update that we're seeing right now on 2020 and how COVID-19 has played a tremendous impact in our industry.
I do have another question here. Do you have clients that have obtained a loan and returned it? And can you explain why they would do that?
We personally, in our practice, have not had any clients that have had a loan and then returned it.
Mm-hmm.
But the reason you would do that is a couple different, is that if you got the loan and then determined that you weren't, after the fact that you didn't feel like that you met the requirements, right, or that it wouldn't be in everyone's best interest to take that loan money. I mean, you've seen the
right.
article.
It won't be advantageous to do that, right?
Right. So. From maybe a political or a
yes,
marketing perspective.
Right.
But for the most part, our clients who have taken the loans have not returned them.
Okay. All right. Well, thank you, Nancy. I really, really appreciate all your great insight on all of this. And now Cassandra from MSHDA is going to be discussing the utility allowance changes at MSHDA, as well as the long-awaited, I feel, I've been in the industry way too long, but the e-signature policy. I think that's awesome. So take it away, Cassandra.
Oh, well, first of all, I just want to say, it sounds like there's construction outside my window, so I'm sorry.
Oh, that's all right.
Can't control the outside.
No.
And thank you for having me. Just wanted to start off with continue what Nancy was talking about. The IRS notice 2053 talks about waiving certifications. First of all, we are allowing them to be waived, but they have to be pre-approved by your asset manager.
Okay.
So if you wanted to do this or you're not able to, you need to discuss it with MSHDA before you just give up and don't do something. And we're still encouraging everyone to continue to do certifications and using different methodologies. Obviously, in person, still not out there. So phone calls, internet, emails, Zoom meetings. I've had people who actually recorded conversations in Zoom to show that they actually filled the paperwork out based on what the tenants were telling them.
Yeah.
And our utility allowance policies, basically, MSHDA is trying to become more proactive in our compliance division than what we ever were. So we're looking to, as soon as anyone has a utility allowance policy or a new utility effective using HUD, rural development, obviously if it's approved through MSHDA, we're going to know about it since we're the ones doing it.
Right.
MSHDA, everything is due now October 1st with the budgets and for the regular tax credit program, so actual consumption, and everything is effective January 1st. So as soon as you get something that has an effective date, we want those sent in to us.
Okay.
Um,
Just so you're saying, like, if we have a September renewal for our Section 8 contract, then we would send it to you in September. Now, do we need to provide all the backup data and everything to you, or you just want the approval?
we're looking for the approval. So you get your.
Want all of our data? Come on.
I'm hoping that HUD and RD and the rest of them are doing their job correctly.
Okay.
We want to enforce them.
Okay. Sounds good.
Yep. So like I said, proactive, we're looking for it up front, not doing it at our annual owner certifications that are due at the end of the year.
Yeah.
We're actually going to take that out of there and just make it so we're doing it as things come in.
Okay.
My last topic that I was going to talk about was our e-signature policy. We did finally get that out. HUD came out with it. We've been trying to push it. So basically we're doing these by management company because obviously the owners and the agents are working together. So we're accepting them by management company. So for any properties that you manage as a company, you can send in one form to us. That form must include what vendor you are using to create electronic signatures. You can apply at any time. I originally sent a deadline out that's now passed, but that was more for budget season.
Sure.
So if you miss that deadline, you're not out of the water. You can still apply at any time. Basically, we are allowing all forms between the owner agent and the tenant to be done electronically, except for home. Home has not approved electronic signatures on the tenant file forms. Asset management will accept any of our forms that are on our website as electronic signature. And those are all listed out in our policy. And each year, the owner or the agent has to recertify what vendors they are still using. So we're making that due March 1st every year. So we're just wanting to know that you're continuing to use the same systems or if you've changed something. And that for me is as simple as it is, but I don't know if there's questions on that.
Oh, it looks like we do have a question here. C. Mathis, go ahead. I'll unmute you.
You knew I'd have a question, Cassie.
There you go.
So my question is, electronic signatures are great, but are we allowed to electronically store the files? In other words, I don't need a paper file anymore.
That would basically be allowed if we are doing electronic signatures. If you have home units, as far as I know, HUD still wants wet signatures, so I think you have to keep an actual file for those.
Okay. So anything but home, I'm good.
You should be, yes.
I believe there is some encryption requirements in
Yes.
storage that HUD is, that they're mandating. And I am not as technical as what in depth that they have outlined. So, but it does seem fairly complex. But and then there's, I believe, a few software programs that are, I guess, approved for that encryption and storage. So I think that would be something that we would need to be cautious about.
It's true.
All right, Nancy, I do have another question. We've got another question regarding the 8609's reasonable clause. How did that impact tax filing season for 2019?
It definitely impacted tax filing season in a couple of different ways. Remember, because we're doing the reasonable cause statement, we can no longer electronically file the returns, which meant that we had to paper file the returns and actually send them to the clients to get their signature and have the clients mail them out. So we're hopeful that, again, that the that the IRS allows us to change the Form 8609A at some point in time so we can continue electronically filing that. In addition, because of the reasonable cause statement, we had to get a lot more additional information from the client to be able to put together that reasonable cause statement to submit with all the documentation for these returns so we could go ahead and take these credits in the 2019. Also, one of the other things that happened is that we could go back and remember I said under the BBA that you could no longer amend returns. One of the things that under the COVID legislation, you were able to go back until September 30th, 2020, which just happened, and amend your 2018 and potentially 2019 return to go ahead and take these credits and amend them versus doing the AAR procedure. And we had to September 30th. Again, typically, if you amended those returns, we had a method that you could electronically file them. If we're using the reasonable cause statement, we were not allowed to electronically file them. So we had to go through the process of getting the wet signatures and mailing these into the IRS.
Okay. All right. Thank you. And Cassandra, I've got another question. So as far as this seems like all of 2020 with COVID has allowed us to kind of introduce some new things. We're no longer going to be, as of now, having like physical file inspections through MSHDA. So are there things that look like they're going to be adopted through MSHDA that, from to make something good from this year? So have something a little bit be easier. So I don't all mind the electronic file submissions. So those are fairly easy.
Actually, it's kind of funny because I've heard both sides of this.
Really?
Oh, yeah. My responses have been, well, if they were here, they would have seen it and I wouldn't have missed it.
True. There you go. That's true. That's true. So
I think my inspector right now, the file auditor is actually, I think he likes getting them in person to see instead of everything electronically.
Okay. All right.
A little harder for him. I think he's, so I'm not sure if we will or we will not.
Sounds good.
And of course, we have to rebid out our contractors. So that's coming up soon too. So we'll see how all of that plays out and what does and doesn't. I don't think there's an issue with doing file audits electronically as long as everything is there. The encryption obviously is in place. So it's something that we could do. Obviously our physical inspections did start up again. We have been in 2 different regions. We're not forcing it on anyone yet, but we're out there trying to do things.
Yes. So, well, unless anybody has any additional questions, I'm going to give it to Tanya and to kind of just close out our session here.
Yeah, we would just like to thank everybody for joining the compliance session today and being a part of the virtual Cinnaire MSHDA Asset Management Conference. This has really been wonderful. So thank you everyone for all your participation today. And thank you, Nancy and Cassie, for all of the updates that you presented today.
Yes, definitely. This has been awesome. So I've loved this venue and we are so excited as a team to be conglomerating and making this happen. So thanks everyone.
And Holly and Tanya, thank you guys so much for your leadership on this session. It's been fantastic and we really appreciate you guys and our presenters, Nancy and Cassie as well. Thank you.